Ever pondered what makes Warren Buffett, the world's most successful investor, so extraordinarily proficient in his trade? Meet the man behind the legend. Warren Buffett, the CEO of Berkshire Hathaway, is widely regarded as the greatest stock investor on the globe. His investment prowess has amassed him an impressive net worth of $121 billion as of 2023, a testament to his unrivaled acumen in the financial world. But what sets him apart? What rules does he abide by that have led him to such monumental success? Is it sheer luck or a carefully crafted strategy? Well, the answer lies in his unique approach to investment, a set of guiding principles that have become his trademark in the investing world. Let's dive into the mind of this investment maestro and uncover the rules that guide his strategy. Rule number 1 in Buffett's book: never lose money. This guiding principle is central to Warren Buffett's investment philosophy. It's not about making quick gains and gambling with your hard-earned savings. It's about preserving capital and consistently growing wealth over time. Buffett's strategy is to thoroughly research and understand businesses before investing, reducing the risk of loss. Here's the kicker. It's not just about avoiding loss, it's about making informed, calculated decisions that lead to steady, long-term profits. This rule underscores the importance of doing your homework before making investments, of knowing the ins and outs of a business, its strengths, weaknesses, and potential for growth. It's a rule that encourages patience, diligence, and above all, caution. So let's take a leaf out of Buffett's book, shall we? Remember, as Buffett would say, rule number 1, never lose money. Rule number 2, never forget rule number 1. It's not all about the brains, but the guts. Isn't that right, Mr. Buffett? Indeed, Warren Buffett, the CEO of Berkshire Hathaway, and widely regarded as the world's greatest stock investor, places a strong emphasis on temperament over intellect. You see, it's easy to get swept up in the highs and lows of the market, to act on impulse rather than reason, but Mr. Buffett, he dances to a different tune. He stays focused on his long-term goals, regardless of market swings. Let's take a look at the financial crisis of 2008. While many panicked and sold, Buffett held his ground. He knew the intrinsic value of the companies he had invested in and trusted in their long-term potential. That's the power of temperament. It's about maintaining a cool head when others are losing theirs. It's about patience, discipline, and the ability to weather the storms of the market. Remember, in investing, your temperament can be your best friend or your worst enemy. Choose wisely. What's better than a quality stock? A quality stock at a reasonable price. Warren Buffett, the world's greatest stock investor, has always emphasized the importance of investing in quality stocks, but only at prices that make sense. This strategy is about understanding the worth of a company and not being swayed by market fluctuations. It's about recognizing the value and potential of a company and buying its stock when the price is right, not when the market dictates. Consider Buffett's investments in companies like Coca-Cola and Apple. These are companies with a consistent operating history, dominant business franchises, and high and sustainable profit margins. He didn't buy these stocks when they were the hot topic of the market. He bought them when they were reasonably priced, and then held on to them. This approach requires patience and a keen eye for value. It's not about jumping on the latest trend or being swayed by market hysteria. It's about finding companies that are undervalued but have solid long-term potential and investing in them at the right price. As Buffett says, price is what you pay, value is what you get. Wise words from a man who knows a thing or two about making successful investments. In the world of quick flips and instant gratification, Buffett plays the long game. He advises investors to hold on to their stocks for a long period of time, not swayed by the winds of popular opinion. Buffett's strategy is not about making a quick buck, but rather about investing in businesses that provide value and are likely to continue doing so over the long haul. Let's consider Buffett's long-term holding of Coca-Cola shares. Buffett first bought Coca-Cola stock in the late 80s, and despite the ups and downs, he has held on to it, reaping the benefits of its continued success. His holding period? Well, it's been over 3 decades and counting. Another example is American Express. Despite the company facing several hurdles, Buffett's belief in its core business model and leadership has kept him invested for more than half a century. These examples show that Buffett doesn't see stocks as mere ticker symbols or temporary opportunities for profit. Instead, he sees them as ownership in businesses, with the intention of holding them for as long as they remain solid enterprises. In the words of Buffett, our favorite holding period is forever. Are borrowing to invest? Buffett would advise you to tread carefully. The Oracle of Omaha, as Warren Buffett is often referred, warns against the dangers of excessive borrowing. He champions the idea that debt can act like a chain that slows down your financial progress. Let's take an example. Imagine you've borrowed heavily to invest in a company, but then the market takes a turn for the worse. The company's stock plummets, and you're left with a hefty debt and a worthless investment. This is a risk inherent in leveraging debt. On the flip side, when you save and invest, you're not beholden to creditors. You're free to make your financial decisions without the looming pressure of debt repayments. This freedom can lead to more informed and less risky investment decisions. It's important to remember that while borrowing can amplify gains in good times, it can also amplify losses in bad times. Remember, as Buffett warns, do not save what is left after spending, but spend what is left after saving. This approach can help you avoid excessive borrowing in the first place. It's about being wise with your money. And that, according to Buffett, is the cornerstone of good investing. Know your strengths and invest accordingly. Buffett certainly does. An important rule that Warren Buffett lives by is investing within your circle of competence. This means investing in areas where you have a deep understanding and expertise. Buffett isn't just throwing darts at a dartboard, he's making informed decisions based on his knowledge of the business. Let's look at some examples. Buffett has a knack for identifying companies with a consistent operating history and dominant business franchises. When he invests, he's not just looking at the potential for quick profits. He's looking at the long-term sustainability of the business model, the strength of the brand, and the company's ability to weather economic storms. Take his investments in companies like Coca-Cola and American Express. These are companies with a long history and a strong brand presence. They have proven their ability to generate profits over the long term, and they operate in industries that Buffett understands well. He's not venturing into unknown territory, he's sticking to what he knows. And that's the key takeaway here. You don't have to be an expert in every industry. You just need to be an expert in the industries you choose to invest in. As Buffett advises, never invest in a business you cannot understand. Numbers don't lie, and Buffett knows that all too well. His keen attention to market capitalization, debt levels, and earnings per share when examining companies is a testament to his meticulous investment strategy. Let's break it down. Market capitalization, or the total market value of a company's outstanding shares of stock, provides an overall picture of a company's size and growth potential. Buffett often seeks out companies with large market caps, as they're typically more stable and less likely to face financial hardship. Next up, debt levels. Debt can be a double-edged sword. It can fuel growth, but too much of it can lead to financial instability. Buffett prefers companies with manageable debt levels, striking a careful balance between leveraging opportunities and maintaining fiscal health. Lastly, earnings per share, or EPS, is a direct reflection of a company's profitability. The higher the EPS, the more profitable the company. Buffett uses EPS as a key indicator of a company's financial performance, favoring those with consistently high EPS. These three pillars, market capitalization, debt levels, and EPS, guide Buffett in his quest to find undervalued stocks with solid long-term potential. In Buffett's words, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Hold on tight, for Buffett's investment journey is a long ride. A marathon, not a sprint, best describes Warren Buffett's approach to portfolio maintenance. He's not a trader, but an investor, and his long-term strategy is a testament to this. Buffett maintains his portfolio by keeping a keen eye on the market's ebb and flow. He uses market volatility, not as a deterrent, but as an opportunity. When prices dip, he doesn't panic. Instead, he sees a bargain. For instance, during the financial crisis of 2008, while others were selling, Buffett was buying, investing $5 billion in Goldman Sachs, which yielded significant returns in the years that followed. On the flip side, when the market is riding high, Buffett doesn't get carried away by the euphoria. He remains focused on the fundamentals of his holdings, and if the prices are right, he isn't hesitant to sell. His sale of Disney shares in 2004, after a significant price surge, is a prime example. And so it's clear that Buffett's long-term portfolio maintenance strategy is about patience, discipline, and a contrarian mindset. As Buffett once said, "The stock market is designed to transfer money from the active to the patient." So what does Buffett's investment wisdom boil down to? It's about understanding the core principles that have shaped his approach. Let's recap. Firstly, protect your capital. The cardinal rule is to never ever lose money. Secondly, temperament often trumps intellect. Stay focused on long-term goals, ignoring the inevitable market swings. Thirdly, seek quality stocks at reasonable prices. Look for businesses with consistent operating histories, dominant franchises, and sustainable profit margins. Fourthly, embrace the long-term, buy and hold stocks, riding out market volatility. The fifth principle cautions against excessive borrowing. Leverage can be a double-edged sword, and Buffett warns us to wield it cautiously. Sixthly, invest within your circle of competence. Stick to what you know and understand. Seventhly, pay attention to market capitalization, debt levels, and earnings per share. These factors are key in analyzing a company's financial health. Lastly, maintain your portfolio for the long term, adjusting only when the market presents attractive opportunities. By applying these 8 rules, you can navigate the investment landscape with a bit more confidence. They offer a roadmap to informed decision-making, embodying Buffett's philosophy of patient, informed, and disciplined investing. In the end, as Warren Buffett himself says, investing is simple but not easy.